Hi, I'm Doug Carroll. Welcome to Introduction to Fixed Income Securities and Markets. This module is designed to familiarize participants with the basic features and characteristics of fixed income securities and an overview of the markets where those securities are traded. Let me begin by providing an overview of what to expect over the course of this module. We'll start out with an introduction to fixed income securities, primarily focusing on basic features and terminology, though touching on who issues such securities and why they are issued. The presentation then moves on to the markets wherein the securities are issued and traded. A wide variety of instruments with diverse structures trade in the fixed income markets. Many will be introduced and described in some detail in other modules. In this introduction, let's focus on the most common type of fixed income security, bonds, and use them to illustrate some of the fundamental characteristics of the securities. Bonds are issued, that is, sold to raise money, by governments, government agencies, or private corporations. The proceeds are used for a variety of reasons, such as funding capital investment, meeting operating expenses, or to refund, in other words repay, debt that's being retired, among other possible uses of the proceeds. The fixed income markets are a medium enabling issuers to raise funds and providing investors with a mechanism to trade securities. The ability of the original investor to sell the bond, there's no requirement bonds be held to maturity, reduces the risk to the investor, so allows the monies to be borrowed at a lower rate of interest. As the presentation turns to a discussion of markets, we'll begin by putting the fixed income markets in context, discussing bond or fixed income markets as an element of the capital markets. After putting the fixed income markets in context, we'll consider the two important segments of the fixed income markets, the primary and secondary markets, where securities are respectively issued or traded. The final segment of the presentation will focus on issuer and credit sectors. What are the major market sectors as defined by different types of issuers and different levels of creditworthiness? Let me finish the introduction by giving you a sense of scale regarding the size of the fixed income markets. How large are the fixed income markets relative to the real economy? This is perhaps not the most apt comparison, though it is one that's often made. Comparing the markets to the economy is not an apples-to-apples comparison, as the markets are a stock measure, the amount of securities outstanding at a given moment in time, and the economy is a flow measure, the amount of production over some period of time. Using the U.S. as an example, as of mid-2014, the dollar value of outstanding fixed income securities was approximately $37.5 trillion versus annual real gross domestic product of about $17.5 trillion. So in the case of the U.S., the fixed income markets are a bit more than twice the size of the real economy. That's consistent with what's observed for most advanced economies, where the fixed income markets are typically 2 to 4 times the size of the real economy. Fixed income markets tend to be less developed in emerging economies, so on balance are smaller relative to the size of economic activity in that context. What's a bond? Well, in substance, a bond is really nothing more than a loan. It's just that it's a loan that's been created in a fashion that allows for relatively easy transfer of the loan to another investor. In other words, a bond is a loan whose contract provisions and original sale satisfy any legal or regulatory requirements so as to facilitate relatively easy transfer from the buyer at issuance to some subsequent investor. In many respects, bonds and loans are essentially the same, but different terminology can mask those similarities to the uninitiated. Let's consider the terminology used when describing or discussing bonds and loans. The two instruments share many features, though in some instances different words will be used to describe features common to both. Both bonds and loans entail an exchange between two counterparties. One of the parties receives funds and as a result incurs an obligation specifying terms of repayment, normally with interest. The provider of funds in a loan transaction is referred to as the lender, whereas in a bond offering, it's investors that are providing the funds. The borrower is the party obtaining funds under the terms of a loan transaction. An issuer is the receiver of the proceeds of the bond offering. Note the effect of equivalence. In effect, the issuer of the bonds is borrowing the proceeds of the bond offering from the investors. Differences in the structure of the most common form of bond offerings versus loan originations cause fixed income market neophytes to make false distinctions between bonds and loans that further obscures their effective equivalence. That misimpression is exhibited in the diagrams on this page. Oftentimes, people conceive of loans as transactions between a single borrower and a single lender, while a securities offering is made by a single issuer but sold to many investors. While these descriptions are generally true, there are numerous exceptions. For instance, in the case of a large loan, a single lender might not want that amount of credit risk exposure to a single borrower. Say ExxonMobil wanted to borrow $3 billion and acquired about the possibility of a loan from JP Chase. JP Chase might decide that's an excessive amount of credit risk exposure to one corporate borrower to want to fund the entire loan by itself. However, if it didn't want to forego the business, JP Chase could organize a syndicate of banks, that is, have many different lenders contribute to the funding of the ExxonMobil loan. In the corporate banking world, it's common to have large loans wherein many lenders are providing funds to a single borrower. On the other hand, in the private placement market, sometimes an entire bond issue is placed with a single institutional investor. There are even fixed income securities in which the cash flows payable to investors come from many different borrowers. The cash flows are typically derived from a pool of loans or other credit instruments, which are obligations of many individual borrowers. This is the structure of mortgage-backed securities and asset-backed securities, debt instruments where the debts of many borrowers have been packaged for resale into a single issue of securities. Principal is a concept one encounters when considering either bonds or loans. However, principal doesn't necessarily carry the same meaning for both instruments. For loans, principal represents the amount borrowed and the amount that would have to be repaid, along with the contractual interest payments to pay off or extinguish the liability. With bonds, on the other hand, the connection between the bond's principal and the amount borrowed is less certain. A bond's principal is the amount the security holder is to receive, along with the contractual interest payments, for the debt to be paid off or the liability to be extinguished. To that extent, principal has the same meaning for bonds and loans. But while the principal is the amount due the bondholder, it is not necessarily the amount that was borrowed, the issue price of the bond. That's because bonds are often issued at prices other than par. Yet even if a bond is issued at a price other than par, whether issued at a premium or discount, that is, at a price above or below the par value, it is nonetheless the principal amount that has to be paid to the bondholder to extinguish the debt. While the implication of principal amount versus the amount borrowed can differ for bonds and loans, in other regards, principal carries the same implication for both. Whether considering a bond or a loan, the periodic coupon or contractual rate of interest is payable on the full principal amount. Also, with respect to the timing of repayment, no matter whether it's a bond or a loan, a term bond or loan implies that all of the principal is to be returned at the time of the final payment, the maturity, Whereas if it's an amortizing bond or loan, that means the principal is to be paid according to some schedule over the life of the contract. Naturally, the party obtaining funds via either a bond issue or a loan is going to have to compensate the provider of those funds. Interest payments are the compensation the provider of funds receives for giving the issuer or borrower the temporary use of their monies. For loans, the cost of funds is typically referred to as interest and can be expressed as an interest rate or in dollar amounts. For bonds, the cost of funds is expressed in the form of a coupon rate, an interest rate sometimes referred to as the nominal yield, which is payable as a specific dollar amount to the holder of the bond. We see again the effective equivalence of bonds and loans. The compensation to the provider of funds on a loan is simply referred to as interest payments, whereas payments to the bondholder are referred to as coupons. As was previously discussed with respect to principal payments, the timing of interest payments can vary depending upon the terms of the contract. For most loans, the interest is payable over time, that is, over the life of the loan. Those interest payments would be specified explicitly in the terms of the loan contract. For bonds, the interest, the coupon payments, are made in the form of a periodic coupon. The frequency of coupon payments, compounding frequency in the parlance of the business, depends upon the bond contract terms, which usually reflect market conventions for that type of issue. Most loan agreements require payment of interest, and in some cases partial return of principal over the life of the loan. While it's possible a loan would require no payment of either interest or principal prior to maturity, that's a very uncommon structure for loans. Though much less common than bonds entitling the holder to periodic coupons, there are bonds that provide the investor with no payments prior to the ultimate maturity. The only payment due the bondholder is the face amount or par value at maturity, that amount representing both a return of the original investment as well as interest on the investment. That is the structure of discount securities and zero coupon bonds. For most bonds, interest will be payable over time, that is, over the life of the security. But for some securities, none of the interest is due prior to the maturity. Earlier, we briefly touched on zero coupon bonds and discount securities, which are two examples of such instruments. Both zeros and discount securities promise their holders a single cash flow, the face amount, which is payable to the holder at maturity. The interest earned for holding such a security to maturity would be the discount from par at which the security was purchased to begin with. Bond coupon payments can be structured a number of different ways. Most debt securities have fixed coupons, so the rate of interest is constant over the life of the bond. But of course, securities can have much more complex coupon structures. Some securities have coupon rates that float or adjust over time. The bond contract will specify a formula at which the coupon will reset. Typically, the floating rate coupon will be based on some specified rate, known as an index rate. An index rate simply being a market rate that is used as the basis for setting the rate on an instrument whose rate adjusts over time. LIBOR, the London Interbank Offered Rate, is a common index rate, although there are many others. And most floating rate instruments do not pay the index rate flat. For most issuers, the index rate will be adjusted by a differential, which reflects the market's perception of that issuer's credit risk. For example, a coupon formula might be based on 3-month LIBOR plus 0.75%, or as would be expressed in a shorthand fashion, L plus 75, the 75 being 75 basis points, a complicated way of saying 0.75%. While it's not common, some bonds will have a coupon that varies according to some specified schedule. That schedule might be time or event-based. Such a feature is referred to as a stepped coupon or split rate coupon. The coupon is initially fixed at one rate for some period of time, but then resets to another, usually higher rate, one or more times over the remainder of the bond's life. Or a coupon could reset not based on some date, but rather be triggered by an event, such as a credit rating cut. Now that we've introduced the basic characteristics of fixed income instruments, let's talk about the markets in which they're traded. We'll start by putting those markets into a broader context. Bond or fixed income markets are a subset of the capital markets. Using the capital markets as a starting point, let's discuss the role fixed income markets play in the operation of the financial markets and the real economy. Markets typically are a mechanism for bringing together buyers and sellers. That's generally true whether what's being discussed is a bond market, some other segment of the capital markets, or for that matter, farmers markets or flea markets. So one might imagine that capital markets are a medium for bringing together buyers and sellers of capital. That, as it turns out, is one of the primary functions of the bond markets, as well as securities markets generally, of which the bond markets are a subsector. But conceiving of capital markets as only a mechanism for channeling capital into real investment is a bit overly simplistic. There is not necessarily an exchange of capital in all capital market transactions. There are certain types of derivative contracts, and even some insurance contracts where no money would change hands at the time the contract is entered into. So if capital doesn't change hands in every capital market transaction, what is actually being exchanged between the two counterparties in any capital market trade? Well, what's always affected are the risk profiles of the buyers and sellers' asset or liability portfolios. So even though channeling wealth into real investment is perhaps the most widely appreciated function of the capital markets, a broader way of thinking of capital markets is to think of them as markets for exchanging risks. Capital doesn't necessarily change hands in all capital market transactions. However, parties to any capital market trade will always have impacted the riskiness of their asset or liability holdings as a result of that transaction. Different meanings will be associated with the phrase capital markets by different speakers and authors. Here, we'll use what is probably the most common way of interpreting that phrase. This would be the perspective reflected in most economics texts that broach the subject of capital markets. Oftentimes, though not always, the phrases capital markets and financial markets are used interchangeably, so I will treat them as synonyms. So whether called capital markets or financial markets, what are the primary components? There are four broad segments into which the capital markets could be divided. There are the securities markets. These are the markets that are most directly focused on the channeling of wealth into real investment, which many think of as the primary purpose of the capital markets. As indicated earlier, this is one of the most important, but only one of several important functions performed by the securities markets. There are also derivative markets. The name derivative is somewhat misleading, given the way basic books typically incorrectly explain the nature of derivative contracts. Derivative markets in general perform a significantly different role than that performed by the securities markets. Derivative markets exist primarily to allow participants to manage risks that they would otherwise be exposed to in the normal course of their commercial or financial activities. Then there are the currency markets. These are the markets where an individual currency could be exchanged for another currency. These markets allow for the financing of trade in goods and services between different countries, as well as facilitating cross-border investment, whether foreign direct investment, that is the acquisition of non-financial assets, or portfolio investment, the acquisition of securities denominated in other currencies. And finally, there are the insurance markets, which in a fashion somewhat similar to the derivative markets facilitate the creation of financial instruments for the managing of risk exposures. Each of these broad segments of the capital markets can be subdivided into some number of subsectors. In the derivative markets, we can talk about the markets for different types of derivatives, such as options, or futures, or swaps. In the currency markets, typically pairs of individual currencies are traded for and valued in terms of one another, such as dollar-pound, or Swiss franc-euro, or dollar-yen, and so forth. In the insurance markets, segments are commonly defined by the type of insurance products, such as life insurance, health insurance, property casualty insurance, and so forth. Let's return to the securities markets, wherein the bond market is located. Securities markets have two major subcomponents, the equity markets and the bond or debt securities markets. Equity markets enable the issuance and trading of ownership interests, which are referred to as equity securities or common stocks. Bond or debt securities markets are the phrases used to describe the institutional arrangements which have evolved to facilitate the issuance and trading of debt obligations or credit instruments. This module is entitled Fixed Income Securities and Markets. And yet, in discussing the various capital market segments, you might have noticed the discussion referenced bond markets and debt securities markets. Why did I use those words rather than saying fixed income markets? Oftentimes, authors or speakers on this subject will use those two phrases interchangeably with one another, as well as with the phrases credit markets, or for that matter, fixed income markets. Naturally, it depends on how one is using language. Do the words imply a specific meaning, or are they intended to make a general reference to something? Frequently, authors or speakers will use all four phrases interchangeably as a general reference to the markets we're discussing, in an attempt to make their words more engaging than if they had repeatedly used exactly the same phrasing. However, since this is an introduction to the subject, to build a solid foundation, it's best to start with a degree of technical precision. And if we are going to be technically precise, the four phrases are not completely synonymous with one another. So let's sort through the detail as a way of establishing a solid grounding for our discussion of fixed income markets and instruments. The task can be simplified a bit, as bonds are debt securities. Ergo, the phrases bond markets and debt securities markets are synonymous with one another, though not with the other two phrases. So let's sort through some of those distinctions. Which of the markets under discussion, bond or debt securities markets versus credit markets versus fixed income markets, is the broadest or most encompassing of the three? As we'll see, one of these markets completely subsumes one of the others, and probably 98 to 99% of the third. So which of these is the broadest category? Well, that would be the credit markets. Credit markets being the name used to describe the markets where credit instruments are created or originated, and then possibly traded. So, what are credit instruments? A credit instrument is a legal agreement specifying the transfer of payment of funds between two counterparties. Those two counterparties might generally be referred to as the obligor, the party that owes the funds, and the obligee, the party to whom the funds are owed. Such a contract or instrument will specify the terms of payment, when principal is due, as well as any interest due on that principal. Bonds and loans, discussed earlier, are examples of credit instruments, but there are a wide variety of credit instruments, some of which are debt securities, but many of which are not. Here we will see several examples of different credit instruments, specifically mortgages, credit card receivables, and auto loans. In each case, those credit instruments were created as a result of some transaction and typically relate to how the transaction was financed. A mortgage is created when a home buyer borrows some portion of the purchase price of the property. Home sellers normally expect to be paid in full. Buyers usually put down somewhere between 5 and 30% of the cost of the property and borrow the balance owed to the seller. In return for lending the funds to complete the purchase of the home, the lender wants evidence of the indebtedness. That is what the mortgage represents, the mortgage being a type of credit instrument specifying the terms of repayment of principal and payment of interest on the loan against real estate. Credit card receivables are created as a result of any transaction paid for by use of a credit card. This example assumes a credit card holder is purchasing a meal at a restaurant. To pay for the food and beverage, the diner hands over the credit card. Processing the payment results in the restaurateur being paid by the credit card issuer. The diner now owes the price of the meal on the credit card account. In other words, a credit card account receivable has been created. The final illustration here is of an automobile purchase. In the typical auto transaction, like the home buyer, the car buyer usually has to put down some money, though car purchases will often entail an even larger percentage of the cost being financed compared to a mortgage. Again, in return for receiving funds to complete the purchase of the auto, the car buyer now owes the lender the amount borrowed plus interest, the evidence of the indebtedness being reflected in a credit instrument known as an auto loan. This exhibit tries to capture some of the ideas just expressed about credit markets, the markets for all credit instruments, whether individual borrower-lender transactions, through large issuances of securities. So any agreement specifying the transfer of funds between two parties is effectively a credit instrument. But how about those distinctions referenced earlier between credit markets and the bond markets versus the fixed income markets? As indicated earlier, all bonds or debt securities are credit instruments. Therefore, by definition, bond markets are a subset of the credit markets. However, only a subset, as many credit instruments remain bilateral contracts, either held as an interest-earning asset on the balance sheet of the original lender, or in some cases sold to another investor. However, if the credit instrument is never turned into a security, securitized in the parlance of the industry, such an instrument would be considered part of the credit markets, but not part of the bond markets. All bonds or debt securities are credit instruments, but not all credit instruments would be considered bonds or debt securities. On the other hand, in some cases, credit instruments not originally created as securities are subsequently securitized. Through a process referred to as asset securitization, a sponsor might decide to buy up some number of mortgage loans, have the title to those loans transferred to a legal entity created for this express purpose, and then they will sell interests in that special purpose vehicle as mortgage-backed securities. A similar process is done with a wide range of different credit instruments. The mortgage-backed securities market is the oldest of the structured finance markets, dating all the way back to 1970. By the 1980s, market participants realized the structuring technology developed for mortgage loans could be adapted for a variety of credit instruments. So starting in the mid-80s, sponsors developed similar structures for auto loans. Create a special purpose vehicle, acquire a number of auto loans, transfer the title to those loans to that special purpose vehicle, then sell claims against the special purpose vehicle. Those claims are considered a type of asset-backed security known as auto loan ABS. A variation of that process was followed for a number of different types of credit instruments. Credit card issuers realized they could obtain cheaper financing by securitizing their receivables rather than simply selling unsecured corporate debt. Credit card issuers would move some number of credit card receivables off of their balance sheet into a special purpose vehicle, then sell claims against that special purpose vehicle, resulting in the creation of another type of asset-backed security known as a credit card receivable ABS. In fact, aside from real estate-related asset-backed securities, resulting primarily from the securitization of home equity loans, auto loan and credit card receivable asset-backed securities represent the two largest segments of the asset-backed securities market. Hopefully, we've made a clear distinction between credit markets and bond markets. But what about fixed income markets? All bonds are fixed income securities, but not all fixed income securities are bonds. That dichotomy results from a type of equity security known as preferred stocks. Preferred stocks are considered fixed income instruments. But let me be clear here. The vast majority of fixed income securities are credit instruments. Any debt security or bond, by the way the terms are defined, would be considered credit instruments. But preferred stocks, at least from a legal or accounting perspective, are usually considered equity securities. However, while considered equities from a legal or accounting perspective, as investments, preferred stocks behave a lot more like bonds than common stocks. Just like most bonds have fixed coupon rates, most preferred stocks have fixed anticipated dividend rates. Just as many bonds have credit ratings that assess the issuer's ability to pay interest and principal in full on a timely basis, preferred stocks will have credit ratings that assess the issuer's ability to pay the anticipated dividend in full and on time. Preferred stocks will also often have many other terms that are found in bond contracts. Both bonds and preferred stocks are frequently callable. Both bonds and preferred stocks in some cases will be convertible into other securities. So from an investing, trading, and analytic perspective, preferred stocks have so many bond-like features they're lumped into a category of securities that includes bonds, fixed income securities. Thus, to do an asset allocation analysis of a portfolio that includes debt securities, common stocks, and preferred stocks, when segmenting that portfolio into the various asset classes, such as fixed income versus equity, preferred stocks would be considered part of the fixed income allocation, not part of the equity allocation. But since preferred stocks are not credit instruments, preferreds would, technically speaking, not be considered a part of the credit markets. Let's delve further into the fixed income markets by discussing two segments we divide markets into when trying to describe or analyze the functions performed by the markets in the operation of the real economy. There is a significant difference in the main functions of the primary market versus those of the secondary market. Transactions in the two segments differ in terms of the typical counterparties, as well as the motivations of those counterparties. While distinct market segments, nonetheless, the two have a complementary symbiotic existence. The greater the efficiency of either, the more effective the performance of the other. Primary markets are those markets where the sale of securities by or on behalf of an issuer are conducted. The role of the primary market is to help issuers raise capital. An issue of securities can be structured in a variety of ways. The most common being a securities underwriting, where a syndicate of brokerage firms and banks buy the securities from the issuer with the intention of reselling the securities to investors. However, in some cases, securities are sold directly by the issuer. While direct placement by the issuer is typical in private placements of securities, for public offerings of new issues, Direct sales are much less common, typically used only by large frequent issuers of securities such as major country governments. Secondary markets are markets for the trading of previously issued securities. These are typically non-issuer transactions. It's possible both the buyer and seller are investors exchanging cash for securities. However, given the difficulty of matching buying and selling investors for securities that trade as infrequently as most bond issues, many, if not most, secondary market trades will have a buying or selling investor on one side of the transaction with a bond dealer taking the other side of the trade. While secondary market trades do not result in additional capital for the issuer, a thriving primary market cannot exist without a reasonably well-functioning secondary market. Most importantly, the secondary markets give bondholders an ongoing access to liquidity, as well as providing updated information about risk and expected returns. Secondary markets allow for ongoing repricing of securities as markets respond to new information. Beyond that, the ability to trade enables investors to pursue a variety of risk management and risk mitigation strategies. Let's consider some of these issues in more detail. One of the most important functions of the capital markets is channeling wealth into real investment. Real investment refers to investment in either tangible assets, such as buildings or machinery, or intangible assets like patents or trademarks. Real investments represent actions that attempt to directly enhance economic welfare through enhanced productive capacity, either through expanding the stock of physical assets or increasing the output from the existing stock of physical assets. Buying securities is not considered real investment, as securities represent either ownership of or claims on the cash flows generated by real assets. Simplified economic models have wealth accumulating in the household sector and real investment in plant, equipment, and new product or process development taking place in the business sector. The securities markets provide a mechanism for businesses to raise money from investors to fund real investment, providing investors securities as evidence of their claims on the issuing corporations. While lacking some significant details concerning the way fixed income markets operate in the real world, even such a simplified version of economic reality captures important elements of the nature of modern capital markets. Most direct investing and trading of fixed income securities is done by institutional investors. Institutional investors are entities such as asset management firms, pension plans, insurance companies, or mutual funds, to name a few. But for whose benefit are these institutions acting? Asset managers for their clients, pension funds for current and future retirees, insurance companies for the benefit of their policyholders, mutual funds for its shareholders. So to a large degree, the institutions are acting on behalf of their beneficiaries whom, for the most part, populate the household sector. Another shortcoming of the simplified economic model of capital markets regards issuers. Business corporations are significant issuers of both debt and equity securities, but far from the only issuer of debt securities. The diverse levels of government, national, regional, and possibly local, as well as government agencies, are also significant issuers of debt securities. Some issuers of debt come to the market so frequently and sell such a large volume of securities that they're able to distribute securities directly to investors without the assistance of an underwriter. Because these issuers come to market so often and sell so many securities, a large number of institutional investors and security dealers will be ready on short notice to buy nearly all the securities offered for sale. Some national governments and a very small number of private corporations would have this capability. The vast majority of corporations, government agencies, and even some national governments require assistance when issuing securities. Most frequently, those offerings are structured as a firm commitment underwriting. That name is quite descriptive because the manager and the syndicate members are making a firm commitment to buy the securities from the issuer. This means they will be liable for the purchase of any securities they're not able to sell to investors. An underwriting syndicate is a group of firms, typically banks and broker-dealers. They have joined together to accomplish a specific task: distribute securities on behalf of the issuer. Once that task is complete, the syndicate will be dissolved. In a firm commitment underwriting, the manager and the syndicate members are guaranteeing the issuer an agreed upon amount of money for the entire bond issue. That money is guaranteed to the issuer regardless of how successful or unsuccessful the resale of the bonds to investors. The manager and the syndicate members are hoping to resell those bonds to investors for more money than they've promised to the issuer. Therein lies any profit to the underwriters. Offerings of this sort usually go fairly well, which is why investment banking is often a high profit margin business, and securities underwriting is one of the primary activities of firms engaged in investment banking. A recent example that makes the point: the Apple Corporation has sold two of the largest corporate bond offerings in history in the last several years. Apple sold $17 billion worth of bonds in the spring of 2013, and another $12 billion worth of bonds in the spring of 2014. Let's take the second offering to illustrate a securities underwriting. Deutsche Bank and Goldman Sachs managed the offering for Apple. While the underwriters were looking to sell about $12 billion worth of bonds on Apple's behalf, they received orders for about $50 billion worth of bonds. There were more than $4 of bids from investors for every $1 of par value of bonds the syndicate had to sell. Unsurprisingly, in such a circumstance, all of the bonds will be easily sold. The greatest difficulty from the underwriter's perspective was keeping their clients happy. Obviously, not all orders could be filled in their entirety. However, there is no guarantee offerings will go so smoothly. In fact, the first time a corporation tried to sell $1 billion worth of bonds, the offering went very poorly indeed. By today's standards, $1 billion is not a particularly large offering. Recall the Apple offerings referenced a few moments ago. Unfortunately for the underwriters, when they tried to sell $1 billion worth of IBM bonds in 1979, things did not turn out as well. The underwriters priced the bonds too aggressively, at only a slightly higher rate than the same maturity U.S. Treasury notes were yielding. Market rates started rising during the underwriting, making the IBM bonds even less attractive. Ultimately, the syndicate was able to sell only about half of the bonds to investors. As it was a firm commitment underwriting, IBM received the issuance proceeds promised by the syndicate. To the underwriter's misfortune, only about half of the funds came from investors. The other half came from members of the underwriting syndicate who were obligated to buy all the bonds not yet sold to investors. The other segment of the fixed income market to discuss is the secondary market. As was just discussed previously, the primary market facilitates the raising of funds for issuers, such transactions resulting in the origination, in other words, the creation of securities. The secondary market entails the trading of already outstanding, that is, previously issued securities. For the most part, secondary market trades are non-issuer transactions. The issuer of the bonds is normally neither the buyer nor the seller in a secondary market trade. In many transactions in the secondary markets, both the buyer and seller are investors exchanging money for securities with one another. However, given the organization of the bond market, oftentimes on one or the other side of the trade is a bond dealer, bringing together an investor looking to buy or sell a specific bond with another investor seeking to dispose of or acquire the same amount of the very same security at the same time is quite problematic. Financial intermediaries have evolved to bridge the gap between buying and selling investors by making a market. This is a structure known as a dealer market. Dealers, or market makers as they are sometimes known, are firms that hold themselves out to others as being willing to buy or sell certain bonds on a more or less continuous basis. Naturally, this is not a service dealers provide for free. The dealers participate in the market to make money and expect to be compensated for providing liquidity. When making a two-sided market, the dealer is quoting both a bid and an ask price. The bid is the price which the dealer is willing to buy securities an investor is seeking to sell. The ask price is the price at which a dealer is willing to sell securities an investor is seeking to buy. The bid is below the ask price, so if a dealer makes a simultaneous buy and sell at those quoted prices, the dealer makes the spread. That's the difference between the bid price and the ask price. A closer view of dealer activities comes later in the session. Here, let's consider the major functions performed by the secondary markets. Previously, I had stated that one of the primary functions of the capital markets was to channel wealth into real investment. Clearly, in a secondary market transaction, there is no wealth directly being channeled into real investment. The proceeds of the trade are going to the selling bondholder, not the issuer. So how do secondary markets contribute to economic welfare? Well, they do so in two significant ways. First, the secondary market provides liquidity. Recall the earlier mention of liquidity. Liquidity meaning the ability to sell an investment prior to its stated maturity. That ability to turn an investment into cash is an attractive feature. Certainly, if forced to hold securities all the way until their maturity, investors would have to think long and hard before committing money to an investment that didn't return their principal for 5, 10, 20, or more years. In fact, some fixed income securities have no stated maturity date whatsoever. They are perpetual instruments. And even if one has a long investment horizon, life is change. Personal circumstances change. Expectations about the future change. The existence of markets that allow investors to dispose of securities prior to the maturity causes investors to be much more willing to buy long maturity securities. While providing liquidity is perhaps the most obvious function of the secondary market, each trade has an important byproduct, a price agreed between the buyer and seller. One of the best ways of estimating the value of an asset is the amount another market participant would be willing to pay for it currently under normal market conditions. The interaction between buyers and sellers, acting on the information gleaned from their research, is a process sometimes referred to as price discovery. Prices in a market system are signals that provide information that presumably allows for more efficient allocation of capital. So the other important function of secondary markets is generating these price and interest rate signals. Primary markets price securities, but only once, at the time of issuance. Secondary markets facilitate an ongoing reassessment of value. Dealers or market makers will quote the values at which they would be willing to buy or sell securities. There are a variety of ways security values can be expressed. To broach the subject from a more easily understood perspective, price quotes will be used to illustrate market making. While we won't investigate it here in any detail, fixed income values can also be quoted on a rate basis, or as it is sometimes said, on a yield basis, as well as by price. This means expressing the current market value on the basis of some interest rate, which for most bonds would typically be its yield to maturity or yield to call as appropriate. Yields and yield quotes are explored in a later module. Let's consider bond quotes in context. Recall the earlier discussion of the secondary market for bonds. The structure was described as a dealer market. Bond dealers or market makers' roles were briefly described as providing liquidity or as standing ready to buy or sell securities. A main source of a dealer's hope for profit would be the difference between the prices at which a dealer is willing to buy or sell securities, a difference referred to as the bid-ask spread. The bid is the price at which a dealer is willing to buy. The ask, also known as the offer price, being the price at which a dealer is willing to sell. Assume a dealer was quoting a bid price of 95 and an ask price of 96. A simultaneous purchase and sale with different clients at the quoted prices would net the dealer the full spread, in this case the 1-point difference between the bid and ask prices. Be sure to interpret correctly the implications of the bid and the ask prices as just described. They are the prices at which the dealer is willing, respectively, to either buy or sell. Naturally, the party getting a quote from the dealer will ultimately be on the other side of any transaction. That means an investor seeking to buy will have to buy at the price at which the dealer is willing to sell, the higher of the two quoted prices, the ask or offer price of 96 in this example. Conversely, an investor wanting to sell can only sell at the price at which a dealer is willing to buy, that is the lower of the two prices, the bid price of 95 in this case. In a sense, the counterparty trading with a dealer is always on the wrong side of the spread. Investors view the bid-ask spread as a part of the cost of trading. We've just finished reviewing the fixed income market segments, where the distinction between the segments were based on the type of activity, issuance versus trading, and parties to the trade, issuer or non-issuer transactions. Another way of viewing the fixed income markets would be from the perspective of issuer and credit sectors. The two broad categories of fixed income issuers would be public and private. The public sector consists of debt issued by governments and government agencies. While the majority of outstanding government debt issues are obligations of national governments, in some countries, regional or local governments issue a significant number of securities. The private sector would be made up of primarily corporate fixed income securities and structured finance. Structured finance includes several categories of securities created by pooling a group of credit instruments, then selling claims on the cash flows of the pooled assets. This process is referred to as asset securitization, which is the process for creating mortgage-backed securities, asset-backed securities, and collateralized debt obligations, or by their acronyms MBS, ABS, and CDOs. The specific contract features and investment characteristics of all the main types of securities will be covered in detail in separate modules. Here let's consider the general characteristics of these broad categories. National governments are almost always the largest single issuer of debt securities in any national market. Direct debt of a national government is often referred to as sovereign debt. Sovereign debt is generally considered as relatively safer than debt of other issuers. National governments are much less likely to go out of business than private corporations. While that is generally true, sovereign debt is hardly risk-free. If you consider all of the countries which have been in existence over a century, only a handful have never defaulted on their debt. In fact, some countries are serial defaulters, having defaulted 3 or 4 times. However, most sovereign debt is relatively low risk compared to other issuer securities. Among fixed income market sectors, sovereign debt is considered the safest. Whereas businesses ultimately have to be able to sell something to generate revenues, governments have the ability to impose taxes and the police powers to enforce them. Most countries also operate their own monetary system, so would never have to default on debt denominated in the domestic currency, as the government can create money out of thin air. Quantitative easing by the U.S. Federal Reserve System is an example of money creation. The policy resulted in the Fed buying nearly all of the net debt issuance by the U.S. Treasury during its 2014 fiscal year. Similar policies have been pursued to varying degrees by the central banks of many countries, including those of Japan and the UK. The phrases risk-free security or risk-free rate are sometimes encountered in the context of the fixed income markets when discussing sovereign debt. Those are references to securities, or the interest rates on those securities, issued by the governments of the larger developed economies that have an independent monetary system. Understand that there is an unspoken but assumed word that should precede either of those phrases. Stated more fully, the phrases would be default risk-free securities or default risk-free rate. These are references to the debt issues by developed country governments with large tax bases, which, when combined with their ability to create money, means such issuers never need to default on the debt as long as there is a willingness to pay. However, holders of these securities would still be exposed to all of the other risks common to fixed income investments, such as inflation risk, interest rate risk, etc. As with other issuers, a national government's credit rating will be a function of its ability to repay borrowings. That, in turn, is largely a function of expected and potential revenues. The primary source of funds to service debt for most national governments are tax revenues, though for some countries, natural resource ownership or royalties, think of crude oil for example, or the revenues of state-owned enterprises are significant. There are a wide range of taxes different governments use to raise revenue. Sales taxes, value-added taxes, income taxes, wealth taxes, real estate taxes, and tariffs, taxes on imports and exports, would be only a partial list. While it's hard to make accurate generalization as tax circumstances vary significantly around the world, in general terms, developed country governments are likely to be more dependent upon sales or value-added taxes and income taxes, as such countries have the technological and financial infrastructure in place to better track the activities upon which those taxes are assessed. Lesser developed countries or emerging markets tend to rely more heavily on natural resource sales or taxes on exports or imports. The creditworthiness of government debt would be a function of the specific sources of revenue and their stability, predictability, or anticipated change over time, all of which likely depends on the nature of the economic activity to which those revenues are tied. In some national fixed income markets, government agencies are also significant issuers of debt securities. As with government debt, it's hard to make accurate generalizations about government agency debt worldwide because specific circumstances vary dramatically from country to country. On balance, government agency debt is perceived as being just a notch below government debt with regard to its degree of creditworthiness. Naturally, a given agency's credit rating will be related to the strength or weakness of supporting revenues, as well as the presence or absence of any guarantees. In some cases, agency debt will be guaranteed by the national government, likely causing such agency debt to have the same credit rating as the sovereign. Absent such a guarantee, it's the stability, predictability, and rate of change of supporting revenues that will likely be the primary determinant of credit risk. Government agency debt could come from a variety of different sources, possibly user fees or other charges the agency makes on those it serves. In some cases, agency debt will be funded via government budgetary allocations or may even require specific legislative action. And regardless of the foregoing, perhaps the most important criteria in assessing credit risk exposure is the degree to which the national government supports its agencies. Even where there is no legal obligation to honor an agency's debt, some national governments will step in and pay off agency debt to avoid a default. The historic record of such support or lack thereof will influence the market's assessment of the creditworthiness of agency obligations. While not true across all nations, in some countries, regional or local governments might also be significant issuers of debt securities. This is much more likely the case in countries using a federal structure such as Canada or Germany or the United States, where the states, provinces, cities, other administrative entities, or their agencies can be significant issuers of debt. On the other hand, in countries that do not have a federal structure, such as the UK or Japan, regional or local debt is not as common. On average, debt of regional or local governments or their agencies would be viewed as riskier than sovereign debt, though safer than corporate debt, on average being the operative consideration. Similar commentary to that made regarding the source of revenues to support national government debt applies to regional or local government debt issues. What are the primary and potential sources of revenue? Type and level of taxes or other fees. What economic activities are those revenue sources related to? How are those revenues expected to change over time? And importantly, is the debt backed generally by all sources of revenue to the issuer? That backing usually be expressed by the phrase full faith and credit, or is the debt backed only by revenues from certain designated sources? In some cases, debt will be supported only by one or more specified sources of revenue, such as a special tax, user fee on designated activities, or project revenues from the facilities built or acquired with the proceeds of the bond offering, but there is no full faith and credit backing from the regional or local government entity. Naturally, in that latter case, the economic strength or weakness of the designated revenue source or sources will be the primary factor when assessing credit risk. Moving on to private sector issuers, let's first consider corporate obligations. In the absence of other guarantees or credit enhancements, the credit risk of corporate securities would be related to the ability of the issuing corporation to service its debt, in other words, pay interest and principal in a timely fashion. Unlike governments, which can impose taxes and have police powers to enforce the payment of taxes, corporations have to be able to sell something to generate revenues. Ideally, businesses generate revenues by selling goods or services at a profit. However, in some cases, corporations will sell at a loss simply to generate revenues to meet various expenses, including debt service. Corporations could also raise money by selling assets or by issuing securities. Because of the greater uncertainty regarding the ability of corporate issuers to meet their obligations, credit risk assessment is usually an important element in the process of selecting corporate securities for investments. Corporate fixed income securities are typically issued under the terms of a contract, often known as an indenture or trust indenture. The contract specifies the rights of the holders and the obligations of the issuer. Because of the primacy of credit risk concerns, many of the indenture provisions are referred to as protective covenants. Protective covenants are designed to allay investor concerns as to credit risk exposure, either by restricting company actions that might adversely affect the issuer's credit standing, such as paying excessive dividends or making acquisitions, or alternatively, the protective covenants might require the issuer to do certain things to reduce risk, by pledging assets as collateral or retiring some portion of a bond issue prior to maturity through a sinking fund. As there is great variation in creditworthiness across the corporate securities market, it is divided into a number of credit sectors. One common distinction is between investment-grade securities and less than investment-grade issues, which are oftentimes referred to as high-yield securities or sometimes as junk bonds. Securities rated BBB or above are considered investment grade. BB and below are considered less than investment grade or high yield. Those two broad credit sectors can be further subdivided to make finer distinctions regarding the relative creditworthiness of different issuers. High-yield securities trade at significantly higher yields than equivalent maturity investment-grade issues because, on average, over time, high-yield securities experience a significantly higher level of defaults. However, do not read too much into the name junk bonds. Realize junk bonds is a name, not an accurate characterization of investment performance. While at times outperformed by other sectors of the market over periods of 1 to several years, over holding periods of 5 years or more, a portfolio of high-yield securities will typically outperform portfolios of investment-grade corporate or government bonds. The last of the issuer segments to consider is the other category of private debt, structured finance, also sometimes referred to as structured securities. The three types of structured securities are mortgage-backed securities, asset-backed securities, and collateralized debt obligations. Each of the different types of structured securities are quite distinct from one another in terms of their sources of cash flow and typical average lives. Indeed, within each category, there are securities exhibiting a wide range of investment characteristics regarding predictability of cash flows, expected returns, and credit risk exposures. But all structured securities share a number of common features regarding the structuring of the offerings. Generally, structured finance entails the securitization of some assets. Most commonly, the asset portfolio or collateral pool is comprised of credit instruments such as bonds, loans of various type like auto loans or mortgages, or other obligations such as credit card receivables. While the aforementioned account for the vast majority of structured finance, any relatively predictable source of cash flow could be securitized. There have been asset-backed issues based on lottery winnings, legal settlements, and music royalties, for example. The common element to all types of structured finance is asset securitization. A portfolio of credit instruments is acquired, legal title is transferred to a special purpose vehicle, after which units of interest are sold to investors. The primary, and in most cases sole source of cash flow to investors would be the collection of interest and/or principal on the credit instruments owned by the special purpose vehicle. As the obligors on those instruments make payment of interest and principal, those monies will be collected, then remitted to investors based on the cash flow distribution rules established during the structuring phase. U.S. agency mortgage pass-through securities, Fannie Mae's, Freddie Mac's, and Ginnie Mae's, make a purely proportional distribution to investors. Each month, investors would receive exactly their pro rata share of every dollar of interest and principal being distributed that period. Most other structured securities involve some structuring of the payout. All the investors are generally earning some interest, though the coupon rates will vary according to perceived risk, especially regarding credit risk and average life. The principal will be returned to the different classes of securities, called tranches, according to some specified priority, often based on seniority of claim. Initially, all of the tranches will be earning interest, but all return of principal would be directed to the tranche that is to be retired first. Only after that tranche is retired would principal begin to be returned to the tranche next in sequence until all of that tranche's principal had been returned, at which point the next due tranche would begin to receive its principal, and so on. Of course, most payout structures are much more complex, but the specifics will be addressed in modules focusing on structured securities.